Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of Greif Inc. Now, what's Greif Inc? They're essentially a company that does or creates packaging products. So they're an industrial company. They create things like large steel drums, corrugated sheets, plastic drums, fiber drums, jerry cans, tubes and cores, protective packaging, closures, adhesives, etc. And you can see here the different distributions here. It's pretty even between container board, steel, box boards, plastics, and other. And then the regions that they operate in, mostly North America, but they do have Latin America and Asian Pacific, and then Europe, the Middle East, and Africa. So that's just something to note. They're basically a company that does a lot of packaging stuff. They will do it for consumers. Basically, if you order something from Amazon or an e-commerce company, there's a chance that Greif actually packaged it, and they will do it also for businesses and clients. I don't think you've ever purchased a large steel drum, but I know companies do. For example, if you want to ship oil or if you want to ship a bunch of other materials that are liquid and sensitive, you may want to use a steel drum, for example. Okay? So, you also see that free cash flow is 481 million. I love when they put that number right there. We can compare it to the 5.2 billion in sales already and just sort of see what kind of free cash flow margins we're dealing with right here. Okay, let's move on. So here they're talking about global industrial packaging, essentially everything that is steel drums, intermediate bulk containers, fiber drums, plastic drums, etc. So this is what they send to other businesses for industrial packaging. And as you see, most of it is steel, some of it is plastics and other. Note that they will depend on the input prices of things. So, for example, if the price of steel goes down, then they will have a good time probably with the input prices. If the price of steel goes up, they will suffer a little bit, right? So that's just something important. And the key market drivers here: large scale manufacturing growth and production, expanding global food consumption and crop yield efficiency, and GDP growth and consumer durable goods spending. So note that all this kind of means that it's actually pretty in line with the global economy. As long as the global economy is growing, as long as manufacturing is growing and crop yield efficiency is growing, they're going to do great. When this isn't the case, they may struggle a little more. So, yeah. Now, we have also their growth strategy. They are accelerating growth through targeted mergers and acquisitions. So, they have been buying a lot in the small plastics and jerry can market. That's been one of their largest sort of acquisition sprees. And you will see this a little bit in the financials later, but that's how they're trying to grow. We also have paper packaging and services. So the other sector was 2.9 billion. This is 2.3 billion in sales. And container boards, box boards, a lot of this goes more direct to consumer. You would be more likely to see box boards and corrugated sheets in whatever you get shipped to you. So the key market drivers here are e-commerce and distribution center growth, nearshoring, infrastructure spending and residential housing construction, and a shift to sustainable paper products, recyclability, and reusable packaging. So they do have their hands in both things, right? That's important. I think it's cool that they are in both of these sectors. You'll see companies that do one or the other. That way, maybe if they do have a lot of industrial demand, but not a lot of e-commerce demand, you still make it up somehow. But at the end of the day, all of this is kind of fueled by the global economy, except with the shift to sustainable paper products. I think that's happening regardless. But regardless, their growth is basically very in tune with increased manufacturing, increased demand, people having money and people spending it. I think that is in general what drives the growth for them. So that's very important to note, as we'll point out later. They also have capital allocation that essentially has some debt reduction, some maintenance capex, some growth capex, M&A, and then some return to cash to shareholders. So this is cool to see just where all their capital goes, and it's cool to see that they have a little dividend, they have some share buybacks, and but they do have to spend a lot on debt reduction. And I wish this debt wasn't here, because then you would get all that more growth and all that more return to cash or return to shareholders in terms of cash. So that's just something to note. The debt does hold them back in some sense. And we'll see why in a second. Now, here is this basically 10-year history for revenue. So you'll see that the revenue actually has downs and ups big time. So it suffered a little bit in 2015, 2016, then went up significantly from 2017 to 2019. 2020 it suffered, 2021 and 22 it did great. Why? Mainly fueled by e-commerce and just higher global demand for things, stuff, after all those cash injections in 2020. And in 2023, the game of musical chairs stopped and they had a double-digit shrinkage. And that's probably going to continue into 2024. So you see here some cyclicality in this revenue history. However, their gross margin, if you look at this, has been improving. So they're getting better at manufacturing for a little less every time. And then their operating margin has also been getting better over time, starting from 7.4% all the way to 11.4%. That is wonderful. Okay, that's great. Their earnings per share, I don't really care about this item personally, but that's fine. But the return on assets, return on equity, and return on invested capital, all of those seem to be improving. So we do have a company that has become more efficient, even though it's become bigger, and we'd like to see that. So you do have some financial strength, albeit as we see it is cyclical and tied a little bit to the global economy. So that's very important. Now, I'm going to make a model. I'm going to calculate how much it's going to be worth based on a discounted free cash flow model. So first of all, we are going to look at this. This is the last 5 years of free cash flow and revenue. So I want to see what percentage of revenue gets turned to free cash flow. Generally, this averages out to be about 6.5%, although it is dragged down by these slightly lower numbers from before. So I'm going to be generous and just say 7% of revenues gets turned to free cash flow, which is still lower than 2023. So it's being generous on one side and being mean on the other. And to estimate where revenue will be in these next couple of years, first, I'm going to go to Yahoo Finance, to the analysis tab, and I'm going to look at revenue estimate. We have 5 analysts here estimating revenue. I think that's fine. Revenue is easier to estimate than earnings per share. The reason why is because earnings per share can be manipulated with stock buybacks or issuing stock, while revenue is a little harder to fake. So here, I'm just going to take the low estimate. I'm going to be very conservative and say that in 2024, they do $5.18 billion, which is a decrease of about $100 million here, and then $5.3 billion for the year after that. So that's what I'm going to roll with, and then 7% of that will be my free cash flow number for my model, basically. So here's my discounted cash flow model. Essentially, what I'm going to do is plug in those numbers for 2024 and 25, and then I'm growing everything by 2%. I'm going to say, in the long term, accounting for ups, downs, and everything, I think that Greif is going to just grow by 2% in 2026, 27, and in perpetuity. And my required rate of return is 11%. That's 1% more per year than the market. And over the long term, that becomes quite a lot, actually. So I'm going to do that, plug those numbers into my discounted cash flow model, add them all up, divide them by the number of shares out, which is 47 million, and I get a fair value of equity of $85.78. However, as I said before, they have quite a lot of debt. So we have to subtract the net debt from this fair value, the net debt being $2.446 billion, and then the fair value post-debt is $33.85. Okay, now let's look at where Greif stock is right now. Okay, so we see that it hasn't been close to the fair value that I assigned to it, really, since basically 2019, 2020, maybe a little chunk of 21. So it's kind of far away, even though there are some indicators that say, for example, the P/E ratio being at close to 9 is quite impressive, actually. It looks low, it looks cheap under certain indicators. The dividend yield being a healthy 3.4% looks good. But then again, the market cap is only 2.92 billion and the debt is 2.45 billion. So there's just something going on here with the amount of debt that they have. And if you look at the free cash flow that they're going to make in every year, I'm estimated around 370,000 or 370 million. Even if before we're saying like they're making 450 million, they won't be able to pay down that debt for a while. It will take at least 5 years, really. So this is just very important to note because this amount of debt is dragging them. And they are making acquisitions, but note that a lot of these industries, the paper or rather cardboard boxes and even the industrial packaging, are single digit growth industries. They're growing at 2%, 3%, 5%, 6% on really good years. However, the debt, if it doesn't have the proper interest rates, if interest rates stay steady and keep going up, well, they're going to suffer because they're not growing by that much. So I think they're being dragged down by the debt here, and I can understand why it's kind of gone nowhere since late 2021. And if you're a shareholder here, you're probably happy if you bought before 2020, but if you bought afterwards, well, I think there's a reason why it has gone nowhere. And what I can say here in summary is that it's not a bad business, but valuation is going to be a little tricky because of its cyclicality and because of the amount of debt. The packaging industry will most definitely grow, honestly. At the end of the day, e-commerce is growing, nearshoring is growing, people are changing to paper products, and then industry will never stop. So in the long term, growth will be very in line with global consumer demand. So if the global economy is healthy, which we will all hope it will be great. On years that the global economy struggles, they will struggle too. That's just something that happens. But the long term will be growth, but it may be single digit growth. A high amount of debt is concerning, especially compared to their available free cash flow. However, if you can stomach it and can stomach the volatility and the cyclicality with the consumer demand, you may have a good business in your hands at the right price. Do I think this $61 level is the right price? Personally, no. This $40 level, maybe we can start talking in the 20s. Yeah, I would definitely scoop some up. But of course, the debt situation is just something that they're going to have to reduce significantly because I feel like it's dragging them behind. Now, the last thought I have here is look how much cash is generated first, and I think that will explain the picture of a whole lot of things. Do they have a lot of debt? Okay, look at how much free cash flow is generated. That's actually the cash money that they have on hand to pay down that debt. So look how much cash is generated first, and then see, for example, how they can maneuver with debt, with dividends, with buybacks. That will explain everything for a company and will make your investments a whole lot clearer. Now, I hope this video was helpful. I hope you enjoyed my analysis. If you want more content like this, don't forget to like, comment, and subscribe. And with that said, I hope you have a great rest of your day.